Hi guys, if today were the last day of my life, would I want to do what I am about to do today? One of the famous quotes of Steve Jobs. Well, essentially, the quote talks about you should work on your priorities first because time is limited and it's true for all of us. Um, I'm starting off this video. There was this video where I wanted to make on divergences for a very long time. It was on my priority list. I couldn't somehow finish it, but then decided today be it. So, on demand, I have created a small video, or I am creating this small video on the divergences that we have covered in our courses. We know that there are two types of divergences, classical and hidden. And to do this brush up in terms of divergences, we'll compare price close, and we'll take up a momentum indicator and let's say something like a relative strength index of any of the period that we can take, or let's say we take a 5-day relative strength index period. So let's start with classical divergences. Divergences are of two types. There's a positive divergence, there's a negative divergence. Positive divergence comes in a falling market, which leads the price to go up. Negative divergence comes in a rising market, which will lead the price to come down. So for positive divergences, you will be looking into a falling market where the market is making lower lows. As the market continues to make lower lows, our indicator will should ideally be making lower lows. A classical positive divergence shapes up when the price continues to come down and make a lower low, but that same phenomenon is not mirrored by the indicator. In this case, the indicator makes a higher low. This is a classical positive divergence which brings in a high possibility for the market to give a bounce back. So you have to remember, in a classical positive divergence, we are looking for a falling market and we are comparing the lows. In a classical negative divergence, we are looking for a market which is going up. A market which is going up and is making higher highs. As prices continue to go up, we should ideally see that the momentum indicator is also reflecting the same thing in making the highs also higher. As momentum continues, price will probably make a higher high. But if we find a scenario where such a higher high in price is not matched by that in the indicator, means the indicator makes a lower high, then this is a classical negative divergence, which suggests a possibility that prices are ripe for a short term or a medium term correction. In this case, we have to keep in mind that we are comparing the highs. As I've been covered this section in our classes, for classical divergence, we are essentially contrarian in nature or contra in nature. Means what? Means that in a falling market, we are looking for a bounce back opportunity, and in a rising market, we are looking for a correction in the market. When we are looking to do the opposite of what the market is doing, we will be looking at the highs in a rising market and the lows in a falling market. Let's look into some examples. Let's say I open up the chart. This is the Spider software that we generally use in our trainings, and do remember this important rule that you should always use a line chart while comparing or looking for divergences. Now, if we come to this section of the current Nifty chart, and today I'm on 13th of August 2016. I see that the index has made a higher high, but our RSI 5 period has made a lower high. This is a rising market. So whenever you find a chart which is rising, and if you ask yourself, is this rise ripe? Is it likely to come down? Then you should compare the highs. On the other hand, if you find a falling market which is coming down. And if you think that is this the end, is it likely to go up after the fall, then you should compare the lows. So classical divergences is contrarian in nature. Then what is hidden divergence? Now hidden divergences, in hidden divergence we have to understand that our approach is not at all contrarian. Our approach is to flow with the trend of prices. In contrarian, in classical, we were against the trend, and in hidden we are with the trend. So if you see a chart which is going up, right, in this case you will notice that is it making higher lows or not. Similarly, the indicator should also match that of price, and it should also be making higher lows. Now if you find a short-term correction where it comes down and then starts to bounce back but still maintains a higher low, but in case of the indicator, if the short-term correction leads the indicator to come off significantly and makes a lower low, this zone is a possible, this is a hidden divergence, and this zone is a possible zone where you can have a good chance to buy because you'll have good risk reward ratio. This suggests that there is a high possibility that the markets from here on will inch up and continue with the trend. What's the mirror image of the hidden divergence in a falling market? In a falling market, in this case, we will be comparing the highs. And I say that these highs are lower. When you compare the price with the indicator, you might find that there will be cases where the indicator will definitely match with that of price, and it will also be making lower highs. If this continues and let's say you have a bounce back and it is still maintaining a lower high, this bounce back will also lead to a bounce back in the indicator. If the indicator bounces back significantly and has already made a higher high, though prices have made a lower high, this raises a possibility that the prices will come down and continue the trend on the downside. This is a hidden divergence, a negative hidden divergence, which can lead prices to come off. What are we comparing here? We are comparing here in this case the highs which are falling, the highs which are coming down. Highs should be lower, but the indicator high has gone up. If this happens, then where this takes place, that is this zone, is a negative hidden divergence, and it raises a high possibility of prices to come off, either in the short term or in the medium term. In a hidden divergence which is positive in nature, we are comparing the lows, a market which is making higher highs, higher lows, but the indicator all of a sudden comes down and makes a lower low. That leads to a zone where it raises a possibility of a continuation of the trend on the upside. Let's try and look into a few examples. Let's say we are over here. We compare from this point to this point. The index makes a higher low. The indicator also makes a higher low. So it be the case here. But look at here in this case. Compare these two lows. These two lows are more or less same or slightly higher. But you look at the low of the indicator, it's lower. So this area tells us that there's a possibility of a short-term bounce back. So was the case here. But as of now, the indicator has made a higher low, and the indicator has also made the price has made a higher low, beg your pardon, and the indicator has also made a higher low. So there's no hidden divergence in this case. Let's change Nifty to some stock. Let's say Infosys. And Infosys, we have recently seen a correction. So let's say you're at this juncture, and you'll be asking yourself, is this point a good point to buy or sell? So you compare this with the previous high and you figure out that these two highs are also higher. But when you compare with its previous highs like this one, you figure out that this current high is higher than this high, whereas the prices are making a lower high. So this zone, this area is an area of a negative hidden divergence, which can lead to a correction. Now, one caveat that I should share with you is, when you're looking for classical divergences, always compare immediate highs and lows, always. Let's say in this case, I have a nice classical negative divergence where prices have halted more or less at the same price. But you see over here, the indicator has come off. So this is a classical divergence. And in this case, you compare the consecutive highs. You do not compare this high with 2-3 highs in the back. Do not do that. But when you're looking for hidden divergence, these highs may have in between minor highs and lows, right? So it is important that when you're looking for hidden divergence, you can and you should actually keep in mind that you will have to negate those minor highs and lows in the middle and compare the major ones. So in the major ones are the ones which is in this case for Infosys, this one and this one. The one before this high is this one, and so on and so forth, right? I hope this attempt of mine will be useful. Thanks a lot for your request for making this video, though I've taken a little bit more time than I had anticipated. Apologies for that. And to make it up, I hope this video was useful. Do tell me your views about it, and I'll be back soon with many such videos. Thank you and happy trading.